All right. Thank you for joining us at ThompsonInsure.com here. We're going to go over the IUL. Today we picked F&G as one of our products, or carriers rather. We're going to be illustrating one of their products, the Pathsetter, for universal life insurance, IULs in particular, out of the state of Maryland. Now, the state doesn't really matter here, but we have training day, a male, 30 years old. All right. We have chose for the solves option is a max accumulation. Max accumulation is basically how we would like to solve for our premium. Are we trying to put more cash in this product? Are we just trying to solve for a face benefit, meaning the death benefit? Do we have a certain dollar amount that we're pretty sure we're able to put in here, right? Which is the premium. Okay, and the face amounts is the death benefit. Maybe we have it to where we want to put so much money in here and we want income to come out of it eventually, right? It pay out or loan us this money over time after we've funded it for years. But this time we're just going to put max accumulation, an individual who's just starting out. And they've heard about the IU and they're interested in maybe getting a policy. We have $150,000 in a death benefit option here. Okay, initial face amount. This is the base, right? And the death benefit option. Now, this is where, if you want to keep it at a level amount, meaning that the death benefit doesn't increase annually. If you go to a B option, it does increase every year with F&G. Now, understand if the death benefit increases every year, it will require you to pay more in premium every year as well. All right. So, this because you pick this option does not mean your premium or per se you will not be required to eventually pay more because the more death benefit you gain and the older you become, the more it's going to cost to insure your life. Okay, so here we have a monthly premium, right? We're going to put this back on an A because we definitely want it leveled. And here is the interest crediting options. This is where, knowing somewhat of how markets work may benefit you or your agent knowing, right? This is important because let's go here. See how the S&P 500 is at 6,000 points, right? This will be called 6,000 points. So just here, you have what we call allocation percentage. So you get to go up to 100%. So I typically like to allocate our funds, say in the S&P 500, uh, with a 1% bonus. Now I did just show you the S&P 500 entry point of $6,000 as of today, $6,068. So if I were to get approved today, that will be my entry point, $6,000. So it's not based on if the market's doing good today, tomorrow, whatever. It's about your entry point and how well the market is doing from the point you got into that index. Okay, so if I got it in at 6,000, if it goes below 6,000, I didn't gain anything. If it goes above 6,000, 6,100, I gain something. All right. So my entry point always matter with these products. But I'm going to put the S&P 500, historically good performing index, and I'm going to do the Barclays Trailblazer. Now, you may agree or disagree with it, but the reason why I like to put these two in particular because each one, as you see, gives you a bonus of 1%. That is at least 2% in bonuses. Let's say if I don't do great for that year, right, or the year to come. Why do I want those bonuses? In my mind, I am trying to hedge against the cost of this policy called administrative fees or a spread, which can be 4%, 5%, depending on the company, sometimes higher, right? So if I don't do good that year, and they say, well, you can't do bad with an IUL because zero is your hero. You don't lose money due to the market going down. Though I have a zero as my hero, I still have to pay fees to that hero, right? I still have to pay a fee for the management of my product. No way around it. So if I'm going to pay a fee with the chance of me not making money, I'm going to at least get a product or get an index rather that's going to help me hedge against those fees. And this is why I pick uh, my indexes with a bonus attached, meaning PTP, meaning I can participate in 100% of what the S&P 500 does. So the S&P does, 100% great that year from what my entry point is. I get all 100% gains on there. Okay. So that's why I picked these products through the fees. And again, your entry point matters. It's not about what it's been doing over time. It's about when you entered into that product. or to that index. S&P, as I just showed you here, is at 6,000. So you will start at 6,000 in about a year or two, depending on the company of your IUL. You're able to change, you'll reallocate where you like to have 100% of your cash value or your level paid up addition to be allocated to. So in a year or two, you may be able to change it to the BlackRock, right? Or these other companies, or these other indexes rather, that these insurance companies offer. Going back to here, let's go to the this is a calculation results. So this is giving me results of 150,000. How much I would pay. It says my annualized premium is $2,021.04. So that means I'm paying $168 a month on this $150,000 product. The minimum I can pay, that's what I like about IULs. They do allow you to be very flexible. So if you're in a position where you cannot make your whole payment of $168 that month, you can go down as far as $46 a month, which is $558 a year. But remember, the least you're paying towards this policy, the more of that money is going towards the actual death benefit, and not the cash value. So yes, you may be able to pay $46, but you're not getting no growth, and the account eventually will, eat itself out at that point. Okay, you'll be forced to pay more eventually. So I only recommend this in a need situation, as needed situation. The whole point of this policy is to be able to overfund it. So, if I wouldn't go down as far as $46. I maybe go to maybe 100 besides 46, right? At least try to participate in that. But it's flexible. You have 168, which is 2,000 a year, to all the way to 558 a year, which is $46 a month if you're getting a hard time. So this is one of the pros of the IULs. It's flexibility. The amount you can do every year is $8,369. You cannot go over that amount, or will be considered MEC, meaning that you will be taxed for that overage amount. The IRS limitations, modified endowment contract, it sets on its policies. Okay. This is the speculative part. This is the hypothetical part, meaning we cannot guarantee you're going to get these kind of returns. Because again, it's the market. I can't predict the market. You can't predict the market. So these are very speculative. So it is speculative that if the market did and at constant rate, I think the S&P 500 illustrated at 5.8%, which is pretty fair. Any agents who market very high are just trying to sell you the product. They're actually supposed to do as small as a percent illustration as possible, because you're supposed to sell the low, not the high. If I sell the low and you do great, of course, my expectations are mainly met. But if I sell too high, typically you're not going to always be satisfied, because when you sell too high, it typically doesn't do as good as you sold it or tried to sell it initially. So agents need to understand that, and a lot of them do it just for commission. So be very mindful of the agent who you're dealing with, because at the end of the day, you're not just getting a policy, you're building a relationship with your financial advocate or that individual who's assisting you. But anyhow, this is, if the market did 5 point something percent, 8% for 10 years, you did it, you contributed $20,000. You got an estimate of 18,000 that you can borrow from or withdraw. Okay. Pretty decent. Not gonna lie to you, there's pretty good returns. The one thing about the IUL, it doesn't give you dividends, which is annual payments on the performance of the company. So you're not getting those annual dividends, unlike a whole life participating policy will give you. Now, depending on your situation, this might be suitable for you. Might not be. Okay. They are more expressed as far as when their applications is concerned, meaning process is a lot faster than a whole life. Whole life will blood and urine you. IULs, not so much. Unless they see something on your medical report, it looks a little funny, then of course, yes, they'll do so. So it's not a lot of checking with the IUL, but be transparent on your application, because if they find out and something happens in between the time of their look back period, which is typically 2 years, they could deny your payout to your family. And you definitely don't want that. But again, this is speculative. We cannot predict that the market's going to do 5% every year. It might do 0 or 1% or whatever between these years. We cannot predict that. So don't get sold or fixated on these numbers because it's the market. And we know in 2025, it's bound to crash one way or the other. The Fed has been printing too much money. Of course, the market's been going at all-time highs, and that's because so much money is being printed that allows money to go into the market, which gives you this deflated dollar and the fake value that the economy is doing good when it's really doing bad because so much money is being printed. So it's going to, the bubble's going to pop. Okay, it's definitely going to pop. It's just when will it pop? Now these products are very good for children because children have the youth on their, in their lives. It's not going to cost so much, and they have the time to deal with the ups and downs of the market. Now, if I would compare this product to a investment, which it's not, but if I were to compare it to an investment, it would be a 401k because it gives you market-like gains, market-like returns. There's still fees involved with this product. Okay, every year, always fees. Compared to a whole life is maybe 120, 150 a month. I mean, a year. IUL is gonna be 2, 4, 3, 6% spreads. It does has against inflation, like a 401k, IRA, or retirement account, investment account. The good thing about this one, there's no tax associated with this product. So your money is growing tax free, but this is after tax dollars. So definitely keep that in mind as well. So I wanted to keep this brief. I didn't want to keep this very long. I know how we are as people. We want the information right now, straight to the point, no chaser, right? So this is the simplest term or simplest form that I can provide you guys of the IUL. It may be suitable for you, it may be not. If you want to learn more how the IUL works, from where the inner workings of it, I do have another video I did on IULs on a whiteboard, kind of give you some scenarios and breaking it down to you more on a whiteboard understanding. Okay, for those who my learners and listeners who like the whiteboard and like to be actually taught some of the ins and outs of it on a more foundational ground of how it works. So if you're interested, go visit us at our channel at Living Equity on YouTube or at www.thompsoninsure.com and schedule yourself a 15-minute consultation. We will love to actually help and see how we can implement either a whole life participating or a IUL into your life. Maybe it's suitable for you. Maybe you need a term for your mortgage to protect your mortgage. Maybe you need a final expense for a loved one who is up in age and maybe can't, qualify for those other products. But again, if you're interested, please reach out to us, and we'll see you on the inside. Take care.